Welcome back. Still tuned into Midcap Radar on CNBC-TV18. Well, TD Power Systems posted a good set of Q3 numbers with a healthy operational show and also clocked nearly 40% growth in order inflow in the first 9 months of FY23. Profit remains steady over a year-on-year basis for the third quarter. Nikhil Kumar, who is the MD at the company, is joining us now to discuss the earnings fine print and the outlook going forward as well. Mr. Kumar, good afternoon. Thank you so much for joining us. It's been a healthy growth in order book in the 9 months. You have clocked in order inflows of 616 crore rupees, which is a growth of 37% on a YOY basis. You had earlier told us that order inflows of around 750 crore rupees is what you're expecting in FY23. Looks like you'll exceed it. So tell us, what are the order inflows looking like in Q4? What will the total order inflow look like in this year and the order book as well?
Yeah, so I guided earlier for around 750 crores of order inflow. We're certainly going to cross that number since we already reached 613 crores. I can't give you the exact number, but it's going to be well in excess of 750 crore. It's going to be 800 crore plus for sure. 800
crore plus, and that would take your order book. The order book is around 1,378 crore rupees. You can end with around 1,600 crore rupees this year.
There'll also be the execution that we'll have in Q4, which will deduct from that number. So I think we will end the year with something like 1,400 crores outstanding order book. Out of that, of course, the Indian Railways, the business that we have with our railway business, the 850 crore. So for the generator business, we will have something like 550 crore opening order book for next year, which is a really healthy situation. And it gives a leading indicator of what we can achieve next year.
Can you talk a bit about Turkey? I know last time you indicated that due to lack of sufficient business and deteriorating economic conditions in Turkey, you are planning to shut down that subsidiary from 30th of April 2023. But as you do that, is there going to be some write-off that the company will have to
we have reduced the manpower gradually. We have some assets sitting over there. It's not substantial. It's about 10-15 crores. So we're not going to shut it down. We're going to suspend the operations for a year, and we're going to see how the economy shapes up over the next 1 year, and then we'll take a final decision next year around this time. I still feel it's a good market to be in. It's a power shortage market, so I think they will come out of their problems. They have the election coming up this year, and there could be stability coming in government policies. They also have a lot of reconstruction because of the earthquake. I'm optimistic about the Turkish market. But at the moment, suspension, final decisions towards the end of this year.
Okay. Exports on the whole is about 60% of your revenues?
Export is about 60%.
60%. Right. And any markets in the export, in your overseas region, which are under pressure? Would you like to just talk a bit about that?
Well, we generally export all over the world, right? So we're not seeing any particular segment of the market which is under pressure. Many of our European OEMs to whom we sell to are banned from selling to Russia. So that is putting some pressure on, not having access to the Russian market through the European side of our business. Other than that, in general, we're seeing all markets doing well and good, very strong order inflows and inquiry levels for next year. So very optimistic about what the prospects for the company for next financial year and beyond.
Okay, so what is the margin difference between export and domestic orders? Is there any, do you get better rates in the export markets?
Slightly better. Overall, we have a gross contribution of about 31%. We want to take it to 32%. But overall, export business is more profitable than the domestic business for sure.
Your gross margins have improved. I think in Q3, it's in excess of 33%. In the comparable quarter of last year, it was 30.5%. What explains the improvement in gross margins? And can you guide on the gross margins and EBITDA margins, which are around 16%?
So last quarter, we had a large number of aftermarket jobs, which are highly profitable for us, and that's improved the gross contribution, above the normal, I would say, trend line. We will end the year around 31-32% on gross contribution. Going forward next year, I expect it to be around 132% once again. Most of the EBITDA margin gains will come through operating leverage. So when we grow our business from 800 to 1,000 and beyond, we're not going to be increasing the fixed costs in the same proportion because we have the capacity in the plant, and therefore we will see an expansion of EBITDA margins taking place from 16% that we have plus minus 16% plus this year, at least 100 basis points increase next year at least.
17% in FY24 at least is what you're expecting. Can you tell us about you spoke about the big opportunity in the railway segment as well. That continues to be a growth driver. The motor business is very small right now, but you are seeing more growth to come in because of the higher spending in railways. What was the contribution this quarter? 40 to 45 crores is the earlier run rate that you've spoken about. How much can it increase to in the next year?
So at the railways business, we have one big order with a major international player who's building the large locomotives for the Indian Railways in Madhepur. So that's about 40-45 crores per quarter. Now, that's going to be a steady 45 crores per quarter for the next 5 years. Additional business that we can get will depend on whether they win the next job, next contract, next tender for the next 1,000 locomotive which is out in the market, and there are one or two players who are bidding for that. So if our customer wins, then we have the opportunity to get that order, which will then double our sales, which will go from 40 crores per quarter to 80 crores per quarter. In addition, we also are in the process of getting our motors approved by the Indian Railways. There will be direct sales to the Indian Railways. There's a 6-month qualification period. We are 1 month into that. We're going to wait 5 more months. And if that succeeds, then we can see around 25 crores per quarter coming in direct from the Indian Railways business. So if everything works out well, we can move from 40 to 100 per quarter if everything works out well.
Thank you very much, Nikhil, for joining in. That's the word coming in from TD Power. It's been a strong quarter and the company is optimistic about the way forward as well. Order wins have been strong. They, in fact, are saying that FY23 order inflows could exceed their earlier guidance of 750 crores and inch closer towards 800 crores. And they are guiding for 100 basis points improvement in their margins for next year. Slip into a very short break. We'll come back and get you more on the market. Stay tuned.